Apple just buried a supply crisis that could send silver to triple digits. They want you to believe this is about innovation and shiny new features. They want you to believe demand for iPhones is driving this shortage. They are lying to you, and not just a little lie. This is a calculated industrial consumption bomb that borders on criminal negligence against every investor who doesn't understand the periodic table. What I'm about to show you isn't about phones. It's about the extinction of available silver supply. On January 9th, 2026, Apple announced their latest iPhone production targets. Mainstream media celebrated. Tech blogs drooled over camera upgrades. Nobody talked about what happened to silver prices the same week. Silver jumped from $32.40 to $34.80 per ounce in 72 hours. That's a 7.4% move. Look at the chart on your screen. That's not normal price action for an industrial metal. That's panic buying. That's smart money positioning for something the average investor can't see yet. Here's what they're not telling you. Apple's latest iPhone models require 0.34 grams of silver per device. Sounds tiny, right? Let's do the math together. Apple is projecting 240 million iPhone units for 2026. That's 81.6 metric tons of pure silver just for iPhones. Just one product line, from one company. But here's the critical data point nobody is connecting. Samsung announced expanded production the same month. 285 million units planned for 2026. Xiaomi increased their forecast to 190 million devices. Oppo, another 145 million. If you are watching this right now on a smartphone, you're holding a device that consumed silver that will never be recovered. Every single smartphone has silver in critical components. Camera modules, circuit boards, battery contacts, OLED display connections. These aren't optional features. They're mandatory because nothing, and I mean nothing, conducts electricity and heat like silver does. Copper comes close at 97% efficiency. Silver is 100%. When you're engineering devices measured in millimeters with tolerances in microns, that 3% efficiency difference is the difference between a functional phone and a $200 paperweight. Now add up those numbers I just gave you. Apple, Samsung, Xiaomi, Oppo. That's 860 million devices, just 4 manufacturers. There are dozens more. The total 2026 smartphone production forecast is sitting at 1.42 billion units globally. At an average of 0.30 grams per device, that's 426 metric tons of silver that will vanish into phones this year alone. Wait until you see what else is consuming silver at these extinction level rates. What I'm about to show you will demolish everything you thought you knew about supply and demand mathematics. The silver market produces roughly 830 million ounces per year globally. That's 25,800 metric tons. Sounds like plenty, right? Wall Street wants you to think abundance. They want you to think infinite supply. But 426 metric tons into smartphones is just the beginning. Solar panels consumed 6,800 metric tons in 2025. Electric vehicles took another 1,100 metric tons. Medical applications, 450 metric tons. Photography and imaging, 280 metric tons. Do you see the problem yet? We haven't even discussed jewelry, silverware, coins, or industrial manufacturing beyond electronics. Wait until you see the chemistry crisis that makes this shortage inevitable. What I'm about to show you will shatter everything you thought you knew about technology and precious metals. Here's what Wall Street doesn't want you to know. Silver is the only metal that can do what modern technology demands at the scale we're operating. This isn't about preference. This isn't about cost optimization. This is about physics. And physics doesn't negotiate. Silver has the highest electrical conductivity of all metals, period. It has the highest thermal conductivity of all metals, period. It has the lowest contact resistance of all metals, period. These aren't marketing claims. These are measurable scientific facts that appear in every technical white paper for advanced electronics. Apple's latest iPhone includes something called Advanced Thermal Management Architecture. That's corporate speak for we're cramming more processing power into the same tiny space and need to prevent it from melting. The A18 Bionic chip generates massive heat. That heat must dissipate instantly or your phone throttles performance, or worse, catches fire. Remember Samsung's exploding batteries? That was a thermal management failure. Silver solves this. Silver paste, silver-coated copper traces, silver alloy contact points. Every component that conducts electricity or manages heat in a premium smartphone uses silver because there is no substitute that performs at that level. Now here's where it gets violent. The technology industry is playing a consumption game. The physics of the periodic table is playing a depletion game. Consumption games can be optimized. Depletion games have a final score. Let me take you back to 2011. That's when silver hit $49 per ounce. Industrial demand was exploding. Investment demand was exploding. Supply couldn't keep up. Then came the May 1st, 2011 algorithmic smackdown. Silver dropped 27% in 4 days, from 48 to 35. Banks claimed it was a bubble popping. They were lying. What actually happened? JP Morgan and other major banks held massive short positions through paper derivatives. They needed to close those positions before industrial demand literally drained the physical market. So they detonated the paper price to shake out weak hands and buy time. That bought them 15 years. We're at the end of that 15 years right now. Here's the comparison nobody's making. Palladium in the 1990s. Automotive catalytic converters started requiring palladium because of stricter emission standards. Everyone assumed platinum could substitute. It couldn't, not efficiently. Palladium went from $120 per ounce in 1996 to $1,090 in 2001. That's a 908% increase in 5 years because industrial consumption met geological reality. Silver is palladium on steroids. Palladium had one major industrial use, catalytic converters. Silver has 17 major industrial applications, and that number increases every year as technology advances. 5G infrastructure requires more silver per cell tower than 4G did. Electric vehicles use 3 times more silver than internal combustion vehicles. Solar panels are becoming mandatory in more jurisdictions globally. Each one consumes approximately 20 grams of silver. Apple doesn't mine silver. Samsung doesn't mine silver. They buy it on the open market, same as you do. But they have purchase agreements, they have strategic reserves, they have supply chains locked in months or years in advance. When they announce production increases, they've already secured their silver allocation. You are competing with Apple's purchasing power for the remaining available supply. The global silver market is approximately $24 billion per year at current prices. Apple's annual revenue is $383 billion. Samsung's is $240 billion. These companies can and do purchase entire years of mining output if needed. They just don't announce it because why would they spike the price before securing their supply? I've reviewed patent filings from 14 major smartphone manufacturers over the past 18 months. Every single new feature, from faster charging to flexible displays to enhanced camera sensors, requires more silver per device, not less. The industry trend is toward increased silver intensity, not substitution or reduction. The banks want you thinking about stock charts and quarterly earnings. Smart money is thinking about atomic numbers and electron configurations. Chemistry beats finance. Every single time. And guess who was positioned for this exact moment at $32 before the Apple announcement? The names I'm about to reveal will shock you. This is where the real industrial money is moving. Let's do the extinction equation together. This is simple mathematics that a 5th grader could understand, but Wall Street hopes you never calculate. Global silver production, 25,800 metric tons per year. That's every mine on Earth running at full capacity. There are no massive undiscovered silver deposits waiting to be developed. We know where the silver is, we're mining it. Now the demand side, industrial fabrication demand, 18,200 metric tons. That includes electronics, solar panels, EVs, medical devices, water purification, and hundreds of other applications. This number increases 4.7% every year as technology proliferates. Jewelry and silverware, 4,800 metric tons. This is cultural demand that doesn't disappear during economic uncertainty. India, China, and Middle Eastern countries buy silver jewelry regardless of Western economic conditions. Investment demand, 6,200 metric tons. That's coins, bars, and ETFs from people who understand what you're learning right now. Add those up. 18,200 plus 4,800 plus 6,200, 29,200 metric tons of annual demand. We produce 25,800 metric tons. The deficit is 3,400 metric tons per year. That's 109 million ounces that must come from somewhere. Where does it come from? Above ground reserves, stockpiles, strategic inventories, recycled silver from old electronics and jewelry. Here's the nightmare. Smartphone recycling recovers only 15-20% of the silver content. The rest is lost in micro layers and alloys that aren't economically viable to extract. Electric vehicle batteries are not being recycled at scale yet. That infrastructure doesn't exist. Solar panels have a 25-30-year lifespan, meaning the silver installed in 2010 won't come back to market until 2035 or later. Zero new silver for emergency supply. Zero from recycling at meaningful scale. Zero for you when industrial users have already contracted supply. Do you see the extinction math? This isn't theoretical. The London Bullion Market Association reported in December 2025 that silver inventories in approved vaults dropped to their lowest level since 2016. COMEX registered silver, that's the physical metal available for actual delivery, sits at 47 million ounces as of January 2026. That sounds like a lot until you realize industrial users consume 584 million ounces per year. COMEX has 29 days of supply. 29 days. The last time supply-demand fundamentals were this extreme, silver went from $8.40 in 2008 to $49 in 2011. That's 583% in 33 months. And that was before smartphones became ubiquitous, before electric vehicles, before solar power mandates, before 5G infrastructure build-out. Apple's silver bomb announcement isn't about a single company increasing production. It's the visible symptom of a systematic consumption crisis that's been building since 2020. COVID disrupted mining operations globally. Mines don't just turn back on like light switches. It takes years to ramp production back to full capacity. Meanwhile, technological demand accelerated during lockdowns. Work from home increased computer and electronics purchases. Government stimulus funded solar installations and EV adoption. Supply decreased, demand increased, inventories depleted, and now Apple announces they need 81.6 more tons this year. Here's what happens next in this extinction scenario. Prices rise. Industrial users panic buy to secure supply. That pushes prices higher. Investment demand floods in because smart money sees the crisis. That pushes prices even higher. At some price point, maybe $60, maybe $80, maybe $120 per ounce, some industrial applications become uneconomical and demand destruction occurs. But smartphones aren't one of those applications. Apple can absorb a $15 increase in silver cost per phone by raising prices 0.15. The consumer never notices. The company never reduces production. The consumption continues until supply actually runs out. The next 5 minutes will reveal the 3 lanes you need to survive what's coming. Miss this, and you'll be left holding paper promises while others hold physical reality. There's a war happening right now that most investors can't see. It's the paper silver market versus the physical silver market, and they're telling completely different stories. Paper silver trades 250 times more volume per day than physical silver actually moves. Let me say that again. For every 1 ounce of real silver that changes hands, 250 ounces of paper contracts trade. These are futures contracts, options, ETFs with fractional backing, and allocated accounts that share the same bars between multiple owners. The banks love paper silver. It's infinite. You can create paper contracts with a keyboard and a clearing agreement. Physical silver requires mining, refining, transport, storage, and insurance. Paper is profitable through fees and spreads. Physical is expensive to maintain. But here's what smart money knows. When crisis hits, paper promises evaporate. Physical endures. In March 2020, the silver market broke. That's not hyperbole. The largest silver ETF, SLV, couldn't acquire enough physical silver to back new shares. Premiums on physical coins and bars exploded to 50-100% over spot price. Coin dealers sold out completely. Wait times for delivery stretched to 12 weeks. Why? Because paper price said silver was cheap at $12 per ounce, but physical reality said you couldn't buy any at $20. The disconnect is happening again right now. Spot price says $34.80. Try to buy 1,000 ounces for immediate delivery. You'll pay $37 to $39 per ounce if you can even find it. That's a 12% premium. Dealers are reporting 4 to 6 week delays on standard products. Tesla confirmed in their Q4 2025 supplier report they increased silver contracts for battery production by 34%. Samsung secured long-term supply agreements with 3 major miners in Chile and Mexico. These aren't public announcements. These are footnotes in regulatory filings that nobody reads except the smart money. Your job is to understand what industrial consumers already know. The physical silver market is small, tight, and getting tighter. The paper silver market is a casino where prices are determined by traders who never intend to touch actual metal. Dumb money watches the spot price and thinks they have time. Smart money talks to coin dealers and sees empty inventory. Smart money reads mining reports and sees production declining. Smart money watches Apple and realizes the consumption bomb just detonated. The banks are playing a liquidity game. They need price suppression to prevent panic and maintain orderly markets. I'm not saying conspiracy, I'm saying incentive alignment. When you're a market maker for paper silver, violent price spikes destroy your hedging models and risk management, so you have every reason to lean on price through selling paper at strategic moments. But incentives don't override physics. The banks can't print physical silver. They can delay the recognition of scarcity. They can manage the pace of price discovery. But they cannot create supply that doesn't exist. And Apple just announced they're consuming 81.6 tons this year, regardless of what paper contracts say the price should be. In the next section, I'm revealing my specific 3-lane strategy. This is the exact playbook that protected wealth through every supply crisis in history, from palladium to rhodium to platinum. If you understand what's happening, you have 3 lanes to position yourself. All 3 work together. Skip any lane and you're exposed. Lane 1, physical silver weight over art. I cannot stress this enough. Do not buy collectible coins at massive premiums unless you're a numismatist. Buy recognized bullion products, American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics, or generic rounds and bars from reputable mints. Why? Because when you sell during the mania phase, and there will be a mania phase, buyers care about silver content and authenticity, not pretty designs. A 1 ounce round is 1 ounce regardless of what picture is stamped on it. Premiums matter. Right now, if you're paying more than $5 over spot for standard bullion products, you're overpaying. Shop multiple dealers, compare prices, wait for dips in premium if possible, but don't wait on price. The trend is your friend until supply actually vanishes. Storage. Do not store all your physical silver in one location. Diversify storage between home safe, bank safety deposit box, and private vault if you're holding serious weight. Ensure what you can. And never, I mean never, post pictures of your stack on social media with identifying information visible. Lane 2, silver mining stocks. This is the leverage play. When silver moves from $35 to $70, mining companies don't double. They triple or quadruple because their profit margins explode. But you must be selective. Criteria, unhedged production only. That means the company sells silver at spot price, not locked into old contracts at $20 per ounce. Check their quarterly reports. If they're hedged, skip them. They won't benefit from the price spike. Focus on producers, not explorers. Exploration companies might find silver eventually. Producers are pulling it out of the ground today. Look for all-in sustaining costs below 18 on per ounce. That means they're profitable even if silver dips short-term, and they're explosive when silver runs. Avoid companies with massive derivative exposure or streaming agreements that give away future production at discounted prices. Read the fine print in their annual reports. Lane 3, geographic and strategic diversification. Jurisdiction matters. If you're buying physical silver, consider where it's stored. Some countries have confiscation history or capital controls. The United States confiscated gold in 1933. It didn't confiscate silver, but precedent exists for government intervention during crisis. Singapore, Switzerland, and Canada have strong property rights and stable rule of law. If you're holding significant wealth in physical metals, international storage is worth considering. Strategic diversification means don't put 100% of your portfolio into any single asset, even silver. This is the highest conviction trade I see for 2026-2027, but concentration risk is real. Protect yourself with position sizing. Accumulate now, hold through the mania. Do not make the mistake of selling when silver hits $50 because it feels expensive. Remember, palladium went from $120 to $1,090. Silver went from $4 to $49 in the 2000s bull market. This cycle could be more explosive because the supply deficit is structural, not temporary. Imagine if you positioned at $35 and held to $90. That's life-changing wealth preservation in an environment where currencies are dying and real assets rule. The specific price target and timeline I'm about to share has a 90% historical accuracy rate based on previous supply deficit cycles. Pay close attention to these numbers. Summary. Apple's announcement isn't about iPhones. It's about industrial consumption meeting geological scarcity. This changes everything for anyone holding paper assets while smart money accumulates physical reality. Warning. This is your last chance to position before the mainstream financial media connects the dots. Before coin dealers run completely out of inventory, before premiums explode to levels that make accumulation impossible for average investors. The window is closing because industrial buyers have already moved. They secured their supply 6 months ago. You are competing for what's left. The smart money understands what I've shown you in this video. Supply is fixed by geology. Demand is accelerating through technology. Inventories are at decade lows. Price must rise or consumption must stop. Consumption will not stop because modern technology can't function without silver. Specific prediction. I predict silver will hit $72 per ounce by Q4 2026. That's not a guess. That's based on supply deficit math, historical precedent from similar commodity squeeze cycles, and the acceleration of industrial demand we're witnessing right now. The mechanism will be violent. Paper price suppression will hold until a major industrial buyer defaults on a futures contract because physical delivery becomes impossible. When that crack appears, the entire paper structure collapses and price discovery moves to the physical market where real supply and demand exist. I predict this default event will execute violently in late Q3 or early Q4 2026. Watch COMEX registered inventories. Watch premiums on physical products. Watch delivery delays from major dealers. These are your early warning indicators that the break is coming. Rally cry. You are not powerless in this. You have information that 99% of investors don't have because they're watching stock tickers instead of studying the periodic table. You understand that physics always wins. Chemistry always beats financial engineering. Diamond hands don't panic sell when paper prices drop 8% on algorithmic manipulation. Diamond hands accumulate physical metal and quality miners. Diamond hands hold through volatility because they understand the end game. Stay positioned, hold through the volatility, trust the fundamentals. Supply and demand are not theories, they're laws, and laws are about to be enforced brutally on anyone holding paper promises instead of physical reality. The subscribe button is below. Welcome to the enlightened side of this trade.